Cisco reported earnings on the 17th of August, and they did a great job. Now, everybody likes it when companies beat by 1 penny, but what do I think? They beat by 1 penny exactly, 83 cents versus Wall Street's expectations of 82 cents per share. Now, if they'd missed by 1 penny, it probably would have been a totally different story. And you might think to yourself, how does 1 penny beating or missing cause such a big deal? Well, that's exactly my point as well. I'm Paul. I'm a value investor. My goal is to look at companies over a long period of time, not just quarter to quarter. Does that mean that I ignore quarter to quarter results? Of course not. I still want to make sure that I'm paying attention to what a company is doing quarter to quarter so that I can determine if my thesis that I made on the company is still correct. Now, some other attributes. This is their press release right here. They came in at $13.1 billion in revenue, which beat the $12.7 billion that analysts had expected from them, which is awesome. But another reason why Cisco is doing very well since the 17th is that they also guided for the future at 2 to 4% for the fall quarter on year-over-year revenue, versus the expectation by analysts of 0.6% year over year. Now, Cisco is an interesting company. It has been around for a very long time. This was written about in 2000 as the first trillion-dollar company when it hit a $500 billion market cap. Now, why do I bring this up? You might be sitting there saying, Paul, that's old news. It's old news, but it's very relevant for today. Why is that? Well, let's go look at our software. So everyone, this is our software for everything money. If you're new to the channel, you'll see it in all our videos. Please subscribe. Let's go check out our chart for Cisco. This is the year 2000. Look at this price, $80 a share. Literally, people here thought Cisco could do no wrong. Guys, since 2000, look at where the stock has been. Look at where it has gone. It has absolutely collapsed. If I told you back here that Cisco would be 22 years later, still sitting at almost half the price it was that year, you'd have said I was crazy. I was dumb. I didn't get it. It's a different kind of economy. A lot of the things I hear today when I talk about some of the companies in the last year and a half that I predicted to fall very hard, which did, and Tesla, which has fallen big time from its high, but still has a long way to go. I actually do believe on this date, August 22nd at 12:08 p.m. Eastern time, timestamp it. I believe Tesla 10, maybe even 20 years from now, will be selling for a lower price per share adjusted for any splits than it is doing today. When you overpay, it ends up being a problem in the future. Stocks are a voting machine in the short run, big votes here, and a weighing machine in the long run. In the long run, the fundamentals and the valuations are what's going to matter. So does that mean we ignore Cisco here? Of course not, guys. Think about it logically. We want to make sure that we buy a company for a reasonable metric of free cash flow and earnings. Of course, we have to pay attention to the balance sheet to make sure it's sustainable. But I look at the quantitative aspects of the business first. If the quantitative aspects and the valuations make sense, I then go look at the qualitative aspects of the business to determine if it's worth the time to invest. So let's look at the 8 pillars here. It is selling for 22 times earnings over the last 5 years and 14 times free cash flow. So I use these 8 pillars to tell a story on the company. So what's the story tell me immediately from here? Why are earnings and cash flow so different? With a lower multiple of cash flow than earnings, it says that cash flow is higher than earnings. That's better to me than seeing it the other way around. So I want to sit there and say, okay, that's something I need to figure out. Are they investing a lot over the years, and that's why they have higher write-offs and higher depreciation? Perhaps. Did they write off a company in the last 5 years that really shot down their earnings? But this is all part of the aspects of looking at a company and determining what questions to ask to determine if I want to buy it. A couple other things. They're buying back shares. Now, buying back shares is good because we want to make sure that we are not being diluted as investors. And we want to make sure that as time goes on, we're getting a bigger and bigger piece of the company. But we don't want to buy back shares of expensive companies. Is this expensive? Is this expensive? Well, they're check marks, but expensive versus not expensive depends on growth level. That's a big factor. So if Cisco is going to grow 20% a year for the next 10 years, this is super cheap. If it was going to lose 5% a year in sales, this is super expensive. So that's a big factor here. And that's part of the whole looking at the whole story. Debt, very low. They can pay off their debt with only 2 years of their last 5 years of free cash flow. That's pretty awesome. They did have cash flow growth, and they did have revenue and earnings growth. Wait a second. Oh, look at this. So this is already a question. How did revenue go up $3 billion and net income's up $13 billion and cash flow is only up $800 million? All right, well, let's go look at the income statement to answer that question. So we go to the income statement in our software, we scroll down, and let's go over the last 5 years. All right. They lost, in the fifth year, they lost $1.3 billion when they'd made $10 billion and $13 billion in the respective years. So let's scroll up a little bit. My guess is there was a write-off somewhere along the way. So we have found it. Here's the issue. Look at their provision for income taxes. 2.2, 2.5, 13.9, 1.24. So we need to understand what caused this big jump in income taxes for that year. I don't know what it is, but it's not a normal operating course of their business from what it looks like. So I would kind of ignore that for right now. So what do we do here? We look at this 8 pillars and we see all these check marks. Do they have a dividend? Yeah, they have a dividend. Their dividend is 3.1%. That's very attractive because the market is currently paying 1.2 to 1.4%. I don't remember the exact number, but this is a sizable increase from the market. So the question you have to ask yourself is, can Cisco afford this dividend? That's an important aspect of the business. Most people out there will see a big dividend and think, great, I'm buying this company, but it could be a dividend trap. Remember, you love dividends and corporate boards and executives know that you love dividends. So to generate some interest in their company, they might pay a higher dividend, take on debt that they can't afford to pay a dividend that they really can't support in free cash flow. So that's why here, 3.1% dividend pays out $6.2 billion. And right above it, we show our free cash flow numbers over the last year, trailing 12 months, and the last 5 years. We want it to be less than half. And guess what? It is. So that's great. They're paying less than half of their free cash flow over the last year and over the last 5 years in a dividend. So apart from something happening in the company where they want to make a big investment, that dividend is probably more secure than others. So I like seeing that. So what do we do from here? Guys, we look at all this data. We don't know what to do. We have to determine a price for the future. Because remember, every investment is the present value of all future cash flow. The less we pay today, the higher our return will be. So what is the right amount? Well, that's why we created the Stock Analyzer tool. So if you're new to our channel, this Stock Analyzer tool will take low, middle, and high assumptions on revenue growth, profit margin, and free cash flow margin, and tell you based on other multiples as well as your desired return, what you should pay for the stock today, not including the balance sheet. It's a great point to sit at and say, should I spend more time on this company or not? That's what we're trying to do. We're just trying to determine what time should I spend and where. So I'm going to do a 10-year analysis on Cisco. You can do 1 to 20 here in our software. And if you like all of this, please, by all means, watch the video, watch this portion over and over. It's important to understand this in order to use our Stock Analyzer tool well as to understand how we look at the present value of future cash flows. So now let's use the Stock Analyzer tool to determine what price to pay for the company today. Now, if you're serious about investing, you're going to want to watch this part several times. This is our Stock Analyzer tool. This allows us to make our inputs on the future, assumptions about the future, and spit out a stock price to pay today, not including the balance sheet, so we can see if we're even in the ballpark. Now remember, guys, I've done videos in the past about Cisco, and I'm sure my assumptions are going to change because I don't memorize exactly what I pick. But the key here is to be consistent in the idea behind being conservative. That is the idea here. So let's start out with our 10-year analysis. You can pick 1 to 20. 1, 5, and 10-year revenue growth numbers. Now, obviously, they had a big year last year, right here, but look at their 10 and 5-year numbers. Very low. And Cisco's a big company. So I'm going to want to make more conservative assumptions. I'm going to go in with 0, 2, and 4% growth rates for revenue. Not huge, but again, I want to be conservative and hopefully the price is below those conservative assumptions. That way, if they do above and beyond, I get paid even better. Profit margin. Now, this profit margin is quite the fluke. So I'm going to ignore that for the last year. But the 5 and 10-year numbers are right around where they're right around consistent numbers, 18 to 18.5%. So profit margins during the bull markets and booming economies tend to be higher. And the last 10 years have been quite the economy. So I'm going to go with 16.5, 17.5, and 18.5. Free cash flow margin. Now, with free cash flow, look at this. Very consistent across the board. 26, 26, 28. So here, I'm going to probably pick 25, 26.5, and 28. PE and price to free cash flow. Now, guys, what I'm picking here is where do I think the PE and price to free cash flow should be at the end of 10 years? Keep this in mind. The larger and larger a company gets, the harder it is to grow. And growth is a major component of PE. But we're looking at this from the growth potential at the end of 10 years. It's already a larger company. So again, It's not going to have as much growth potential unless they enter some new business. But I cannot assume they're going to enter a new business today for 5-10 years from now. So I'm going to be conservative. I'm going to go 12, 14, and 16. And I usually like to keep the price of free cash flow as the same multiple, even though we see here that there's a big difference between profit margin and free cash flow margin. But I'm still going to keep it conservative. And finally, desired annual return. Guys, for large established businesses like Cisco, I tend to put in 12.5% because it beats the market of 9 to 10%. So it gives me an incentive as well as it gives me a proper margin of safety to buy the stock. Now, I'm gonna hit the analyze button. What you're gonna see is 6 numbers. 3 numbers, low, middle, and high based on earnings, and 3 based on free cash flow. If it's all green, don't go out and buy immediately. Verify that all these assumptions are correct. If you're not part of our community, join the community because I guarantee people in our community, thousands of people active every day, are discussing Cisco at some point in the history. You can go engage that conversation. If it's all red, don't worry. The stock is currently at $47.74 a share. If it's reasonably close to that number, do your research anyhow. Be ready, add it to your watch list at the appropriate price, and you'll get notified by the software and the phone app when the stock hits your price. So, analyze button, we've hit it. Boom. Okay, a lot of red here. We have a low of 19, high 20s, high teens, high 20s, a high of low 30s to high 40s, and a mid of 25 to 35. And the reason for the big differences is the big difference between free cash flow margin and PE. So for my personal opinion here, I'm probably going to pick a 37 price here to notify me. That way I can do more research when it hits there. But I appreciate your time. Again, rewatch this video. And if you want to learn more about our 8-pillar process, wait for the next video where we discuss that in further detail. Thank you very much for your time.